Welcome back to the Financial Services What's Up podcast, where we unravel the complexities of the financial services sector in Luxembourg and beyond. And I also say hi to my colleague Björn Evert.
Hi Sandra, good afternoon. Really a pleasure to be back, and hello to all our listeners.
Today we are thrilled to have Julien with us. So Julien is a partner colleague here in Luxembourg, and he is our champion for corporate sustainability activities. Julien is our expert that brings us CSRD, so the Corporate Sustainability Reporting Directive, a bit closer, and also gives us a holistic point of view.
Thanks, Björn and Sandra. I'm really excited to share my view on CSRD and how it impacts the market.
So in today's episode, we are diving into the exciting topic that's making waves in the financial world. We'll explore how ESG and CSRD impact the financial industry with a focus on the banking industry. Are the two of you ready to kick it off?
Of course.
Of course, let's go.
So the ambition is that the European Directive drives transparency, accountability, but also sustainability practices in businesses around the globe. So this is a pretty big ambition. And a lot of companies are looking at CSRD, but rather as a huge, and I would even say massive compliance exercise. So before really starting to dive into the CSRD, I think it's worth that we are setting the scene, Julien, and maybe you can explain the genesis of the directive in a nutshell.
Yeah, so it all started almost 10 years ago with the Paris Agreement, where a lot of countries realized the need to decarbonize the economy, right? So from that Paris Agreement, Europe has committed to net zero by 2050 and has committed to a reduction by 45% of carbon emission by 2030 compared to 19. So in order to do that, Europe will have to follow up the real economy to make sure that those reductions in carbon emission are real through various type of initiatives. And CSRD will basically be the way to expose it to the outside world, to the outside stakeholders that will be interested to see what the company is doing. So CSRD, in a nutshell, is nothing more than a continuation of the NFRD, so the Non-Financial Reporting Directive. And to the contrary of NFRD, which was applicable only to 11,000 listed entities, CSRD will be applicable to 55,000 entities in Europe, basically impacting the vast majority of the economy. CSRD remains a big change because it's much more prescriptive.
And just to jump in here, Julien, I guess the understanding of the genesis of CSRD is really critical to navigate the impact of your business and also of the business of the financial institutions. As you pointed out, you have the Paris Agreement, then we have the Green Deal from the European Union, and I think these are really important steps towards a sustainable outcome and underscores the urgency of the decarbonization. And as you said, CSRD is now a wider range for industries, and I think the reporting structure is much more structured than before. And I think my takeaway is always it's vital that we recognize that CSRD is not only a compliance exercise, it's really a pathway to driving positive change and creating really value for stakeholders.
Yeah, and I think we really set the scene simply because of the target of the European Union that is clearly defined. And we have now 55,000 entities that are in scope and actually need to get ready to be reporting on it. When is it actually kicking in?
So basically, the vast majority of the entities will be in scope this year, so 2024, or next year, 2025, for the non-listed businesses. And there will be a third wave for non-EU-based companies around 2028.
Yeah, so it's good that we talk about the genesis, but we are fully in already. So 2024 is the year.
Yeah, absolutely. Yeah. What Julien just said, I think it's important because it's emphasized the global reach and the significance of this piece of regulation. It's really also emphasizing the importance for proactive preparation and to be compliant with this new piece of regulation.
Yeah, so coming back and starting our dive into the CSRD, when you explained the genesis, you actually mentioned that it's coming from the non-financial reporting. So it's a very different angle from the financial reporting that many of us are actually used to. What I understand is that the concept of value chain, this is an essential part. And would you mind explaining and elaborating a bit of what it means for banks or for the financial sector in general?
Yeah, so first of all, non-financial reporting, as you say, will not only report on the own operation, but some data will be reported at the level of the value chain. That's the impact. Now, when it comes to the value chain itself, we are used to the concept of supply chain, but here we speak about upstream and downstream operation. So we go till the supplier of our supplier, and we might go to the customer of our customer as well. Of course, we embed as well other stakeholders, which might be investors, NGOs, organizations that are around the company. The key challenge for the financial sector will be that basically the boundaries of the value chain is very complex, because in most of the cases, let's say the financing activities or the investing activities will have to be embedded, which makes it a very complex exercise. But I suggest to park it for the moment.
Yeah, okay. Then I suggest that we are going back at the EU ambitions in terms of energy transition and decarbonization. Well, the financial industry has to play a critical role in that aspect. And I think I would even say, if we are bold, that the financial industry is in the driving seat to actually finance the real economy through debt and equity. And so it plays a critical role to actually direct the capital also towards the sustainable activities and finance them.
No, that's true. If we come back to what we said at the beginning, so if we want to make sure that the economy is transitioning, if we want to make sure that we hit the 1.5 degrees of the Paris Agreement, the financial industry will have a key role to play, not only to finance sustainable business, meaning businesses that are already sustainable, but most importantly to finance the transition. So we see more and more banks for the moment, which increase their focus on increasing the green asset ratio. We'll come back to the concept later, but this is something which is really trendy for the moment.
You're actually touching already on a topic that's really interesting. When we are looking even macroeconomic and from a strategic point of view of the banks, you know, we see different types of commitment or strategies that are coming from one bank to another. And, you know, if we are taking those strategies, what does it actually have in terms of impact when we're looking at the competitiveness of one bank versus another, and maybe also more global view from Europe versus the other part of the world? What's your view on that?
This is difficult to say at this stage, but what we see is that the pressure that the EU is putting on financial institutions is increasing through various types of regulations. If we want the real economic transition, Europe is clear that it needs to come first from the financing piece, not to let those businesses not transforming. Now, when it comes to banks, we have banks that are located, for example, in countries whereby sustainability commitment is limited, that might still be looking at short-term profit as the key KPI to benefit to their stakeholders, right? So they will continue to focus on profit and might somehow disregard the sustainability impact of their activity. On the other side, if you take large EU-based banks today, the importance that they give to the green asset ratio, which is, by the way, part of the EU taxonomy, is more and more important. So they are really looking at financing activities that are showing that they transition in reality. So progressively, we will see the financial sector pushing more and more the real economy to transition, basically.
And just I would like to comment on that. I believe if you look at the banks overall, there is not one business model or one size-fit-all approach at the end of the day. Julien, you pointed out you have regulatory pressure, but there is also a certain political agenda. And not to forget, there also certain pressure from clients and also client demands. That means at the end of the day, so each bank have to think about what's their vision, what's their strategy, about sustainability and how they take that into account in their operation at the end of the day. I think for me, if you look at that, it's critical for them to find a way to balance how they support their clients in their transition journey, what you just said, not only financing the green asset, but also transition. And on the other hand, as a CEO of a bank, you have to make sure that the bank is resilient and they also a certain financial success. I think that we have to also to keep in mind if we look at the strategy of the banks across Europe.
Okay, when you look at this transition exercise, are there some concrete examples that you have seen already in practice?
Yes, no later than a few months ago, one of, let's say, the biggest systemic bank here in Europe already did some crucial announcement. So they mentioned that 2 years ago they entered into discussion with the oil and gas sector, asking them to really put in place a concrete transition plan. They had 2 years to do that. We are at the end of the 2-year period today, and they noticed that the oil and gas industry they were financing did not basically put in place the right level of transition plan with obviously the right level of capex involved in that to really transform their activities. And the bank decided to stop financing those companies. So this is a very difficult position or very end position that a bank can be taking. But what we expect is that we will see that happening more and more towards industries that are not transitioning.
Okay, that's a pretty harsh decision, but clearly shows what dimensions and how to actually we are able to all reach the objective that is at the basis. So we know that actually putting that into practice is pretty complex. And when we are coming back a bit to the challenges, what would be the key challenges that we are seeing? We discussed already the value chain discussion where you were talking about the front end, the suppliers and the suppliers of the suppliers. On the other side as well, the clients and the clients of the clients. What else is actually coming into play that you need to have on the radar screen?
Yeah, if I think about it based on the experience we have currently on ongoing projects, I would say that on top of the value chain, double materiality assessment will be critical for those entities.
That's indeed a word that we have heard a lot, but maybe you can elaborate a bit
So
on that.
Double materiality assessment means the impact of your company organization and its value chain on the environment and vice versa. Impact of the environment on your organization from a cash flow perspective, so potentially impacting the valuation of assets. Now, if we take an investment company, for example, that has in its portfolio more than multiple hundreds of investments across all industries, how will you basically define the principle of what is really material for your portfolio from a sustainability perspective? Okay, how will you do that? You need to find a way to do that in a simple way. You won't be able to reach out to all the 100 or 200 investments. So probably one of the ideas that is coming up from the industry for the moment is to cluster your investment per sector and to reach out double materiality assessment at that level and then to combine them, to consolidate them. So for that, you will need to make sure that the result of your DMA, of course, is remaining sufficiently simple and really targeted towards what really matters at your portfolio level. A second element and a second challenge for any organization, but financial institutions are also impacted by that, is the fact that CSRD will require any organization to report on a yearly basis on their non-financial performance. So to do so, a new type of data will have to be collected. So sourcing that data, making sure that data is complete and accurate will be one of the key elements. Building the correct reporting process for non-financial information when it comes to the process itself, the technology to support the process, the internal control landscape. All of that will be basically ultra critical. What we have noted in recent projects is that the challenge is generally coming from a few elements. First, the project governance or governance around ESG topic in general in the organization. This is something that if you fix sufficiently in advance in your transition plan, will benefit the full efficiency of the transition.
So what you mean is actually bringing the right people to the table so that the discussion can have all the angles that you need.
Exactly, and that the oversight over the full compliance project basically is at the right level in the company. We are speaking about a topic which is really pervasive to the organization. So it should be handled at a sufficiently high level within the organization, probably in the C-suite. Now, it depends on from a company to the other, but yeah, that's what I mean. A third challenge from my perspective is the data collection. We spoke about value chain. We spoke about double materiality assessment. When you will have to report scope 3 emissions coming from your portfolio of multiple hundreds of investments, you can imagine the challenge. So already anticipating the way you will retrieve that data, making sure that that data exists and is robust enough for your reporting is key. And finally, the fourth point that I wanted to mention as a challenge is the limited assurance. So assurance will come from year one of compliance. So there, again, only challenge being on the anticipation and the, let's say, the alignment with your assurance provider to make sure that you can reach the deadline.
Yeah, and Julien, just to complement on that one, I think the topic you raised with data is really key. We see that in all our projects that to fix the data challenge is really one of the major topics in the projects we are driving currently. Because, I mean, banks have to set up, objectives, and going forward, they have transparently report on them. And for that, they need really a huge amount of information. And that's sometimes, not available, not consistent, not comparable. And based on our view on the market, I mean, banks at the moment significantly devote resources to that point to really collect data, analyze data, check them in all dimensions, climate, governance, also carbon footprint. Another element as I would like to add is the topic of the skill set of the people in the financial sector. Because given the regulation which is upcoming, it's really not an easy piece of regulation. It's really complex. You need your upskill, your people in the bank. And also you have to add new people to the bank with probably also different background than only business background or legal background to scope with that. Especially if you look at scope 3 emission, that's not an easy task to be done, and really you need experts on that.
I agree. The risk landscape is really changing fast for banks. Yeah.
And I think also not to forget in all this regulation, all the details and all of that we see, we should not forget the client, because all of the clients are in a transition phase. And banks have to think about how they help their clients to transition. And I think, every client has to put out a certain transition plan. And banks have to discuss with their clients how they do best the transition, how they can finance the transition. I think that's also important. We should not forget.
I think now we can all follow the challenge that we put in the beginning, that is actually compliance exercise and all the elements that come into play. And if we are looking forward about what's coming up, but it's also about linking it to the strategy and still making sure that the bank as such has profit generation goals in the short term versus also balancing a bit more the long-term value creation that also comes into play, underlying to the sustainability aspect that comes into it.
I think you're right. It's a matter of balancing both. Obviously, profit generation will remain a key element. But I believe when we see the dynamic on the market today and the dynamic at political level as well, ESG and CSRD, just to show it to the outside world, will be a very good opportunity basically to improve reputation. Who knows what a bank not active on that side will look like in 10 years' time, but also to improve the resilience of that bank in a market that will probably move towards more sustainable financing activities. I think everything is about a matter of creating value on the long term, as you said, by making sure that you direct your activities toward what really matters to the society. And just to recap, so for any organization today to be able to show it to the outside world, they will have to turn themselves towards CSRD, right? And to do so, there will be multiple elements that will be key in the project, starting by a scoping which is done properly, defining your reporting strategy, making sure that you really report what really matters, performing your double materiality assessment, data gap assessment, and finally transform your non-financial reporting process and to bring it at a level that will allow you to basically deliver investor-grade reporting.
Yeah, so a step-by-step approach is always recommended. So for me, it's now time to wrap it up. And that's when I ask Björn, so what are your 3 key takeaways for this session?
Thanks, Sandra. Happy to do so. So my 3 key takeaways are, the first one is, we talked about it, the financial service industry play really a crucial role driving the transition towards sustainability. And I guess, all the actions banks putting in is important to shape the future of our planet and also our economies. Secondly, I learned from Julien, understanding the value chain is super important, including the bank's own operations, but also where the bank invests and finance is also really key. And then engaging with the entities on their transition journey is not just beneficial, but it's really crucial for shaping your strategy as a bank and also ensuring long-term success on banking level. And then, last but not least, the anticipation and the preparation to transition to CSRD is essential. So you have strategy and governance pieces in this regulation, but also, people aspect, processes and technology. And to be early on to put that in practice is very important to be compliant with this piece of regulation, but also not see it only as a piece of regulation, but I think there are also a positive business impact you can have with a transitioning to CSRD.
Thank you, Björn, for summarizing this up for us. Now back to you, Julien. We have a habit of asking you for a number that strikes you. So, dear Julien, what is your number?
I would say 3, which is the average time needed to perform a double materiality assessment.
3 months?
3 months. So my only advice, anticipate.
Thank you very much. So thank you, Björn. Thank you, Julien.
Thank you.
Thank you, Sandra.
Thank you for this discussion, and I wish a good day to all our listeners.